a presentation on BEPS as a sponge tax. Will U.S. taxable bases be lost in BEPS? Presentation by Charles Edward Andrew Lincoln IV, based on an article in regards to the broader policy implications by David Ernick. So the question is, essentially the summary of the article is, what BEPS is a good initiative, and all parties agree, the U.S., the IRS, the Treasury, and countries around the world, that companies shouldn't be shifting their bases to other countries and evading or fiscally evading or avoiding taxes. But the problem is that the United States might lose some money in this process that it would have been taxed otherwise. So the U.S. has sought to minimize erosion of its taxable base by U.S. multinationals. This is the goal of BEPS as well. But and just to confirm, BEPS, the OECD, they're in cahoots. They're going together. I have citations for these images. They want to avoid base erosion and profit shifting. They want to avoid multinationals, big business, moving money abroad and not paying taxes where they should be paying taxes, even if it's legally a scenario where they're legally not breaking the law, but are very close to pushing the limits. We want to make sure that there's equity and that taxes are being paid. Overall, everyone agrees more or less that this is a good thing. But there are some consequences. The U.S. Treasury Department is focused primarily on stripping the U.S. tax base in multinationals. More on that later, how the U.S. Treasury Department negotiated this without without comments from Congress. But it's also a goal of BEPS. And the foreign countries are gaining more in this scenario than the United States. But as we know, the United States has a lot of infrastructure that needs to be updated. Updated and needs to be kept up as well. So just to confirm, there was a conflict that the article touched upon early on, that the U.S. Treasury was negotiating with the OECD without congressional input. And we have to remember that Congress has the power to rewrite laws. And this was also mentioned in the article, and what I have here, especially in red, is basically what is a summation of a section of the article that I have here. Now, the article goes into an analogy and takes a step back and says, please listen to this analogy because it's going to explain what the problem is with BEPS in the United States. And it asks us to give us a moment of its time for the death and estate tax analogy to credit subsidies. So as the death and estate tax, which I'll explain in a moment, incentivize states to maximize the amount that they could tax, foreign countries will be incentivized to tax the maximum amount that the U.S. will subsidize. So keep that in mind. That's the conclusion. That's the thesis of what this analogy is about. The death tax is basically, in Section 2001 of the IRC Internal Revenue Code, stated that tax imposed by a state will be credited by any amount of a death tax, estate, inheritance, legacy, succession and distribution of taxes, distribution and succession and distribution laws of state taxes, actually paid to a state or the District of Columbia in any respect of the property included in the gift to the state, not including any such taxes paid with respect to the state or another person. So basically, you have credits that are allowed. So the states are told, if you tax this amount, the person will basically be exempted from paying that from the federal government. These are tables from Cornell law that I found. Basically is the federal government has told the states, you can tax up to this amount and we'll subsidize the person. So basically, there's no harm, no foul. There'll be no lobby of people trying to get these taxes lowered. At least it won't incentivize a strong lobby, but you can pay maximize these taxes or the maximum amount. And then it's basically the government giving money to the states. The credit shall not exceed the amount imposed by 2001, or the credit provided by the federal government. So analogously, the U.S. will be crediting taxes that are paid in other countries. You have that being said. So you have situations where even companies will be paying higher taxes in the other countries, and the U.S. will be lacking. So that's what Congress is upset about, that the Treasury Department negotiated with BEPS. So, and that's what the article's main crux is. So the higher tax for U.S. companies, and arguably Apple will have to pay higher amounts of taxes in China and less taxes to the U.S. and the IRS. I'm not talking about the Apple case specifically with Ireland and state aid, but I'm just saying that U.S. multinationals will have to pay higher taxes in the source country. Now, you might say this makes sense, and it really does make sense because wherever the activity is taken out, we seem to imply, at least implicitly, and based on a theoretical basis, that taxes should be paid there. But this is what the article is saying, that the BEPS is going to sponge away taxes from the United States. And that's something that we need to consider because the U.S. does have a large budget, the government has a large budget, and a lot of things are going on. We're not saying that we shouldn't pay taxes in China, we're just saying that we need to be concerned for the U.S. as well. And how this affects, just to reiterate, if foreign countries follow the OECD project, then U.S. multinationals will pay greater taxes abroad and claim more foreign tax credit. Thus, the U.S. tax revenue could be eroded by a huge increase in foreign tax credit. So the issue magnified, in the example, foreign government could impose up to 15% rate because there would be no negative effect on business investments in the U.S. companies for doing so. The U.S. company would face the earnings of the subsidiaries and would pay the same amount of taxes regardless whether paid in the United States or in a foreign country. So, other proposals of the sponge effect, this is just a list. Taxing income globally has posed some challenges for the United States and more companies to opt to employ hybrid structures. In addressing stripping the U.S. base, it's also important to consider so-called hybrid arrangements with respect to payments that do not result in corresponding arrangements. These arrangements serve little function other than produce stateless income, and this could be analogous to issues that we're dealing with in Europe. The OECD and BEPS, there's an action to plan because it could lead erosion in the U.S. tax base and put a strain on the underpinnings of the global tax system put forth in intergovernmental relations. So how this affects the U.S. negatively, like I said, stripping the U.S. tax base, it could negatively affect the U.S. by shifting additional revenue outside the U.S. It could promote excess return because Subpart F of the Foreign Controlled Corporations Act will be separate income for determining taxpayers' foreign tax credit, and it'll cause a raise in foreign taxes and penalize U.S. multinationals, thereby allowing U.S. multinationals to avoid the penalty. My counter thoughts or discussion is U.S. Treasury is really negotiating an arm for the executive treaties, and that's what's allowed as international negotiations such as the UN, that the executive branch is allowed to do. 2, executive agencies are given the authority to determine laws if Congress has not acted. Now, an explanation about this has come out from a Journal of Legislation, the Chevron 2-step, which basically asks, has Congress acted, and if an agency has acted, is the action permissible? This is just to show it's technicality, but it's the Chevron deference that came out in the late 80s, early 90s, that executive agencies are given the authority to determine laws. These are just counterpoints. I'm not saying I agree with everything, but it's good to just analyze things. So Congress was never, but the counter to that is Congress was never informed, and the statutes are not applicable to trigger the Chevron analysis. So in court, essentially you'd be arguing that agencies are given the authority under the Chevron doctrine, but the thing is Chevron doctrine is not triggered because there are no, it's just not a scenario where the statutes are being triggered. Another counter thought for discussion is multinationals should be paying taxes where they work. I had mentioned this before, such as paying taxes in China. But the support for this is Peter Harris, in his lecture to us, mentioned that multinationals often do not mind paying double taxation as long as it's certain what the clear numbers will be for double taxation. And overall, the author does not propose BEPS is outright, opposes BEPS outright, and sees it as valuable, but recognizes the need to keep U.S. revenue. Thank you very much for your time.